So a market is informationally efficient if it can be information can be obtained easily, costlessly. The market contains many buyers, and there's particularly now the internet. You can get information about new events affecting stocks and companies very quickly. There are three in the textbook. It talks about the efficient markets hypothesis. Does this ring a bell with anybody in the news from earlier this week? Did anybody hear about the Nobel Prizes in economics? One of them went to Eugene Fama at the University of Chicago. This is his theory right here. The slide here is what he got a Nobel Prize for. So when you go home in your fall break tonight, you can tell your parents tomorrow you're studying the work of Nobel laureates. His theory, and there were three winners of the Nobel Prize this week. Lawrence Schiller was another one. And Fama and Schiller got diametrically opposed views of market efficiency, and they both got the same prize. Fama basically says that market prices, the prices we observe for securities in the marketplace, fully reflect the information that's available to investors. Schiller, on the other hand, says investors are crazy. They have no idea what they're doing. They're emotional. They make irrational decisions all the time. And investment prices are almost random. And if there's a lot, of course, those are the two extremes. Generally speaking, the finance world goes with Fama's approach, that the basic assets, there'll be temporary moments of insanity and price selling and buying that's irrational, but overall, over the long run, investors are pretty astute about valuing using information to value the securities. There's actually a famous financial advisor in the 1950s and 60s called Graham, and he published a book called Graham and Dodd that investors used for many, many years. And he basically took both approaches, which is essentially most of the time security prices are rational and reflect the basic value of their organization. But there's the speculative component as well, and that's totally unpredictable. That can go up and down. What it means, though, why it's important to you as individual investors and to you as if you work for an investor-owned corporation, is that in the short run, you can see all kinds of market swings, ups and downs. Over the long run, though, it's almost impossible to beat the market. When you look at 10, 15, 20-year rates of returns on mutual funds, I think less than 2-3% of mutual fund managers are able to outperform an index fund. Just one fund that follows the market as a whole. So it is very difficult to make money to consistently outperform the market. Having said that, we have all these huge companies like Merrill Lynch and so on. Merrill Lynch doesn't exist anymore, does it? It merged with someone. I have to update these slides. These things change weekly, it seems sometimes. Because they buy and sell these securities all the time. They help make the efficient market, because when they find out something, they act on that, trading happens, prices adjust. When are they efficient? Well, generally, what stocks, large companies, it's hard for General Electric or HMA or United Health to do anything without everybody knowing about it already, very quickly and acting on it very quickly. However, there is lots of evidence that there are pockets of inefficiency. Just small, infrequently traded corporations, in particular international markets, for example, real estate assets and so on are not efficient. Because why does this exact same house in one county sell for a different price than another house in another county? It could be the fact that there's schools and so on that are observable, but it may be the fact that this house is the one I grew up in and I'm not going to sell it for any price. There's a lot of stuff like that you cannot use that comes into play when you're talking about real estate, art, buildings, and so on. So extremely large companies where treasury securities where it's traded in huge amounts daily, those markets are pretty efficient. Small, infrequently treated niche markets are not as efficient. The only way in an efficient market to have a higher rate of return is assume more risk. So we've got two examples here: is Tenet Healthcare, bonds and stock. Which offers the higher expected rate of return? Would you think? The stocks. I mean, stocks historically have had higher rates of return. However, that doesn't necessarily mean that all of you will go out and buy stocks in Tenet, will you? Because you have to compare it to the required rate of return on the stock, and it's the risk-adjusted required rate of return that you're more interested in. Okay, that's the concepts I wanted to talk about. Are there any questions about the arithmetic or what we've gone through so far?
You said that as investors, equity investors, you have tax advantage. I'm a little bit confused because, retained earnings are taxed, and that's after you have interest that was tax deductible. So where's the incentive?
The incentive is at the personal level. So if I own stock in Tenet and I own bonds in Tenet, I will pay a lower personal rate of tax on the dividend income than I will on the interest income.
Even though it's been taxed already at the corporate level?
Yes. Jennifer.
Slide 17. Is that right? The model can be used when it's 0? So did you go over what happens when it is 0 then?
What happens? Someone help out Jennifer. What will happen if the growth rate is 0?
Same price.
Yeah, it's essentially there's no growth, so the dividend stays the same, the price stays the same. The only way stock prices go up is if the company grows. Otherwise, it won't. Other questions or issues at this point?
Can you have a negative EG value?
Yeah. Look at BlackBerry. I can tell you, those of you who've got BlackBerry, not doing that well. Rochelle?
Sorry, I'm still confused why issuing new stock is a negative signal. Why wouldn't it be signaling potential growth?
It's a negative signal because I, as a management team, if we're thinking about issuing, we need new capital. We don't want to go to and borrow anymore. We've maxed out the banks. We want to issue new common shares. At what point in the business cycle will I want to issue those shares? I'll want to issue the shares at the point where I think that the stock is highly valued. It's trading for really high values in the marketplace. Because if it's selling for $15 a share and it's really only worth $13, essentially I'm getting $15 in when it's really only worth $13. So I'm getting the maximum amount of revenue in from the sale of the shares compared to if I was selling it at 11 and the real value is 13, then I should wait until the price, until the price goes up to the 13, then I should issue it then. So investors are not naive. They know that when management announces a common stock sale, basically it's telling the world, we think that the common share price right now is high. And we're going to issue shares to take advantage of that. So as soon as common shareholders hear that the price is high, what do? They sell off the shares.
They anticipate some opt-out initially, so the market knows that as well.
If they have confidence that the share issue will quickly be turned into additional earnings for the company, the drop may be minimal. But typically, there is a drop. I mean, research shows there's a drop. And that's because of the negative signaling impact.
I have a question, Mike.
said, after an IPO, they can still issue additional shares if they want, right? How does that affect the value of the other stock? Like, does that go down? The price goes down? Like, what exactly happens if they issue additional stock?
That was the second bullet point, dilutes value. So
Yeah.
if you got 100 shares now, and you've got a certain earning stream that goes with those 100 shares, you issue 20 more shares. Essentially, now you've got 120 people sharing the same earning stream. So the dividends per share, the value per share goes down when you issue new shares. Now, at some point, as I just said a minute ago, if the shareholders believe that the new capital will quickly be turned into additional earning streams, then the dilution may be quite minimal. But if they don't have confidence, it could be substantial. But essentially, there is a short-term dilution of value. That is the answer to your question. I should say, actually, in some cases, there's long-term dilution of value. If the additional capital is used to essentially, I'm thinking of something like City of Detroit, which I don't see any financial way that they're going to recover in the short term. But I mean, the for-profit analog to the City of Detroit, a company that's losing a lot of money, issues the new shares, but it doesn't. Essentially, it's used to try and keep the company afloat versus investing in new assets that will bring new earnings. Other questions or comments at this point? So let's try a couple of